Hey everybody, welcome back. Well, the end of the year is here, and let's just look at that closing high of 47.6619 right on our bar right here. We can see that as the peak, and we can see where we're at right here. And what is that close? 47.6982. I told you we were going to close at all-time highs. Who knew? Who knew by 3 pennies or however you want to refer to it? It's just really kind of interesting that we actually pulled it off. I'm actually really surprised by it, candidly. I did not think it was going to happen, but thank you, JPAL. Thank you very much for overshooting, and now you're going to overshoot and overcorrect on the other side. And then we'll all wonder why we need the Fed. But we're not going to get into all that today. November 1st, you can see the move up, and what got us there obviously was JPAL saying what? We're not going to cut, or we're not going to raise rates anymore. Okay, we're going to cut rates 75 basis points because we overshot. Okay. So now we know exactly what they're doing and why they're doing it. What we're trying to figure out is what's going to get us over here. How are we getting through this level? So there's a couple different ways to look at what we're staring at here. We really need to go through this NAAIM data that's floating all over social media that everybody's talking about that's reading the wrong way. Never let the truth get in the way of a good story. So we're going to get into that data, how you should be viewing it. We're going to get into smart money, dumb money. We have to get into the tax selling next week so that you understand what's happening and why it's happening so you don't overcorrect. I don't care if you're going to refer to this as a cup and handle, as we've been saying for months, that this could be building at a handle, and people telling me that that's not what's going to happen. But guess what? I don't care if you call it a handle. I don't care if you call it a banana. It really doesn't matter, right? This is what happened. Why did what happened? And this is really important. I was laughing in the comments because someone said, oh boy, he's going to bring out the stool again this week. And yeah, I actually am. I am going to bring out the stool. I don't know I'm going to do it right now, but I do think that you have to understand that when I'm talking about the stool, what I'm really trying to get people to understand is that there are 3 major parts to the market. And if you don't understand those parts, you're going to have a real tough time actually understanding what's going on. I mean, we might as well just do it, just get it out of the way and just bring it out there. And I do appreciate your comments on these videos, and I do appreciate the sharing. I really appreciate the sharing. You'd be surprised people that aren't even on YouTube that are actually sharing these videos now and just telling people at work and things. So it's pretty interesting, but I appreciate that. And it helps me not have to run commercials in the middle of these, which I know everybody appreciates because that's what the algos really want. But anyway, so you have the macros, the fundamentals, and the technicals, right? This is how I view the market as one big stool. And then when you're sitting here, the market will lean on one of these legs, one or another. If you ever sat on a bar stool, you know what I'm talking about. Sometimes you're leaning on the back leg, sometimes you're leaning on the middle leg, and sometimes you're leaning on the front leg. And understanding how these are all correlated gets you what you see in front of you, right? It's not rocket science. But I think that this helps you understand what's going on. So, and let's just call it what it is. The tail does not wag the dog. Technicals do not make PAL move. Usually, it can happen. It can happen. It's happened in 87. So like, if you see here, we didn't just miraculously stop because you're at this level. We stopped because PAL changed. What happened? Macro. Right? What happened here on the breakout out of the handle? Well, PAL changed. Okay. So when you understand that stuff, what happened here? Why'd we overcorrect? Well, he said, we're done with free money. Remember, $1.7 trillion, all this, everybody was a genius. Everyone's buying JPEGs and calling them NFTs. And then you come here, right? And why did we hit the low here? Because we had a peak. And we're going to get into the divergence here on the NAAIM chart. We're going to get into the divergence right here. Bear with me, get through my first cup of coffee on the day. So I was up planning this video last night a little bit later on what I thought was pertinent. The 3 things that I think are most pertinent for us to go over is not just talk about how right I was with this, that we're hitting a new high, but I think it's more important to talk about what's going on with this data that's floating around that people have no idea how to really interpret that data. So we're going to do that. I'm going to show you how to use smart money, dumb money, and how you can actually interpret that data, make a more informed decision. And then we're going to talk about the tax selling and tax buying that's going to go on next week and how you can profit from it. So that's going to be the 3 parts of this video. I would watch this. It's going to be packed. So we're watching how this is playing out, and we understand that we have to be aware of the macro. You might want to pay attention to what's supposed to happen at the end of January this year with rates. Okay, if he cuts rates and there's only a 16% chance of cutting rates, market's going to go higher. Don't overthink it, okay? As the people in the room laughed when Powell said he was going to cut rates here, and most of social media on YouTube and Twitter was telling people that this is going to be bad, they were laughing at me because I was live at the time and said, just buy everything. And it was very clear because, real rates, we did this on a video a month ago where real rates were going to drop. If real rates drop, then the PE was going to expand. And that's exactly what's happened. So it's not rocket science. It's basic macroeconomics. And that's something that you can really profit from. And I'm going to give you another example of that later today of that. So let's look at this on a daily. And, it's always so pretty when you look at it, right? It's so obvious. It's so clearly obvious when you look at hindsight, isn't it? So this is what we have going for us. We're going to clean all this off. And where I think we could really serve best is an outlook of looking at the weeklies and just look at the MACD. And you can see how we're just rising here. And if we go through these, I could just go here on the Qs really quickly. And we could see how this is going, another new high. I'm not going to pull the futures up because futures are futures and we closed on the year. We'll start doing it again next week. But you can see where we're at and see how you're breaking out. You can see the cup. You can see how we're lifting. You can see how we have room to go. You should be able to see how we have room to go, how we are here and now we're hitting up here. Right? So this is telling you that you have room. That doesn't mean that you go straight up, guys. All right, just remember that when I talk about some of the other things here. If we start taking a look at the Russell, and let's just stick with it and use IWM. And let's get rid of this here. And we'll clean that off and we will clean that off. Duplicated it. Let's clean that off. And I really do appreciate the fact that I can just run through these and don't have to worry about the editing. So here's your multi-year base and you're breaking out, and what's your MACD doing on the weekly? It's lifting. All right. So we do have end of the month and end of the year. And if you take a look at this, I thought this was pretty interesting as well. Look at how you're moving. Look at this close on the month and where you're at. Look at how the MACD on the monthly is starting to cross above that zero line. I thought that was pretty interesting. I thought that was worth paying attention to. I always look at these at the end of the month. I think it's a big deal to look at these at the end of the month. See where you are in May and how you opened up. Down 1, 2, 3, up. If you know this pattern, then you know. I would strongly suggest for those that are traders that you start learning rising 3 and falling 3 patterns. They are the most highest probability pattern out there in candlesticks, period. Okay, they don't have to be perfect, but that's pretty darn glaring, isn't it? As someone in the room likes to say, absolutely glaring. Now, if you take a look at the SPY, this doesn't get any clearer either, does it? So you have room to run here, guys. Up, 1, 2, 3 down, up. Don't play around with that. You do not want to be on the other side betting on this. If you were to look at this chart and you're going to say, oh, well, clearly we're going to crash, or clearly we're going to come in, okay? The market doesn't care what you think. This is what's going on right now. If I was to show you the target of this market based upon what just happened, you'd be surprised at how high this could actually go if you just look at technicals. Again, we have to look at the fundamentals and the macro that's going on, but you want to pay attention to this. So if you're looking at this on a monthly basis and you're looking at these, and then you start drilling into the main sectors that drive the market, okay, what sectors drive the market? Okay, the SOX drives the market. Up, 1, 2, 3 down, up, get it yet? So you have these sectors that drive the market. In other words, the Nasdaq cannot sustain going higher without the SOX. It just doesn't work. You will have periods where biotech can lead, but it's rare, okay? It's really rare. This was interesting, and I showed this the other day. I should actually just show everybody this. I did this in the private room or in the private videos that I do, but hold on one second. Let me clean all this off. So if we're looking at this and what's happening here, let me show you this. So this is XBI, and this is the Ichimoku Cloud. They refer to it as Kumu. This guy spent 30 years building this system, so maybe spend more than a couple hours saying that it doesn't work. And if you take a look at how this is playing out, here it is on the weekly, and you have not been above this for 2 years. And look at what's going on here right now. See? Look at how you're getting ready to cross. This is a leading indicator. If you don't think that, you don't even need to comment. It's a leading indicator. And you want to pay attention to it. So does that mean it works all the time? No, but you want to pay attention to it. I will say this while I'm thinking about it. The people that are out there that are spending like a year or two trading and then saying, oh, this doesn't work, it just might mean that you don't understand how to use it correctly. And I mean that in the nicest way. So you might want to give some of this stuff a little more time and understanding the nuances of it before you say it doesn't work. I would strongly suggest that you consider that, but not to get too into it and digress. You look here at the monthly and you'd say, well, it doesn't work. Yep, for multiple years, This might not work. This might still have a problem up here. Yes. Okay. But that still gets me 50%. So I'll talk about it then. In the meantime, you just have the mother of all failed H's here on the monthly chart. So we would want to take a look at this. But if you look at biotech, you'll have periods where biotech can lead, but usually it doesn't do that. So if we get back to the weekly and you see that breakout there, I thought this was fascinating. I think you're silly to sleep on it. LABU was one that we did in the room, and we absolutely crushed it on it, and we're doing exceptionally well with it. And you're going to see people get a little upset. This counts out about 26 days. So if you actually went here, you want to see something really fascinating. If you counted out 26 days from there, you just kind of marked it off and say, well, where's 26 days? Right there. And that's when you got your signal right in here. And you can see it right there, right? Okay. Isn't that fascinating how that works? So when you look at something like this, I would spend a lot of time just trying to figure this stuff out. But anyway, it's worth your time. If you look at what's going on here, I don't expect us to go straight up. Straight up's not a pattern, right? We want to come back. We want to backfill, and just bear with me as I get through my coffee as well. I would not sleep on these kinds of names, but let's get back to where we were because there's so much that I really want to cover, and I want to go through this as well. So my purpose of these videos is to form and educate. What you do with this data is completely and entirely up to you. The only thing that I would tell you is listen to nobody but yourself. All I'm trying to do is tell you how I view the world, and then you do what you want with it. If you're looking for a guru, this is not the channel. There's plenty of people out there with rented Lamborghinis that will tell you exactly what's going to happen tomorrow. Right? The only thing I know about tomorrow is I'll be drinking coffee. So if you take a look here, 461, every time you get to this 500, what do? So I want to point these out. People will say at the end of this video, well, you told us we're going higher, but then you're pointing at this stuff. There are waves within waves, guys. Okay, you can drop down, but go up in a couple months, right? That can happen. Okay. Again, and I'm going to laugh, you don't have 1.7 trillion injected into the market. So everybody that was smart here that just had to look at their 10 or 20-day moving averages and say, see how smart it is, see how easy this is. Yep. They got absolutely annihilated in here where I did not. But anyway, I digress. If you take a look at what's happening here, you need to pay attention to that. Okay, we're a little over, right? You could say that we're a little over. Maybe we should pay attention to it. It's like that movie, he hits it out of the park. It's too high. Anybody remember that movie? Anyway, Charlie Sheen was in it. So if you see how this is playing out and you see how this is going, is this something that you want to pay attention to? I'm going to pay attention to it. And I always look at the summation more than the oscillator itself, and you can go through that. We did a whole video on this a while ago. I really should clip out some of these things that we go over and put them into a separate educational video when I refer to them like that people can watch them. I frankly just don't have the time. Here it is on a monthly. It doesn't really do much for you. But I do want to pay attention to this, and it is something that I need to look at and go from there. And it is a concern of mine, just like some of this other stuff I went through last week was a concern. You want to run monthly charts, guys, and you want to run them on a bunch of names this week. Okay, I'm going to run through some of them today, but you want to pay attention to this. But when you look at some of this stuff, yeah, I do have some concerns out there. When I look at things like, let's get rid of this now, stocks above their 20-day moving average, and we're all the way up here, right? S5TW, you can go and look at this yourself, or I go look at S5FI. Bear with me, only second cup of coffee. 50-day moving average, and you're at that 90 level, right? This is usually where we reject. So are they waiting to January? To some extent, yeah, I think they are. I think they're waiting until tax season, and we're going to address that. But this is, if you go and mark these areas, this is where we reject. Okay, we just go print these and go and take a look. August 18th, 2022, November 30th, 2022. July 24th, 2023. This was the tail. I'm kind of the tail wagging the dog here, though, aren't I? Because this is when we all became experts in Japanese currency, when they changed their pattern. And we're sitting up here, so we're trying to figure out, how long are you going to stay up here? Like, how long can you stay up here when you start really looking at this? And you go back to 2013. What is the longest period of time you've been up here? And when I went through it, it's either back here in 13 or it's now. Usually you're hitting here and you're rejecting. You're hitting here and you're rejecting. It's not realistic to go and have 100% of all stocks. Remember, you weren't this smart. We were just fortunate to participate. Realistic that 98% of all stocks are above their 50-day moving average. We're not that smart, guys. But there's always an equal and opposite reaction, right? So it's like a slingshot. You were down here at 1, so you got to 98, right? That's how the market moves. You guys already know that, right? So if you look at how we're playing, just be aware of that. I don't know how realistic this is that we're just going to stay up here parked for a period of time. If people will say at the end of these videos, well, he didn't really say what's going to happen. Yeah, because I don't know. The only thing I know is that when the market opens Tuesday, I'll be drinking coffee. So if we take a look here, I do think that I am leaning towards, we had a nice run and maybe we're due for a little bit of a pullback. It doesn't mean that it's going to be like that all year. I think that we're setting up for a really nice year, but we're going to have to see. So keep this in mind, S5FI. I think we'd be remiss to not go through the 10-year right now. And just take a look at what's going on there. This is something that on the year, if you take a look at it, people would go, well, geez, what really happened here? I don't think people fully grasp the amount of money that's in money market accounts that's going to come out and go into equities and bonds yet. I don't think people fully grasp it. I don't think people fully grasp what the government will do no matter who's in power to stay in power, and how they will affect the economy for a year to make sure that they can kick the can down the line. Remember, guys, they can drag out a recession. Okay, they can drag it out and they can push it back to 25 after the election's over. They've done it in the past. They did it in the 80s with Reagan. So I don't care what side of the aisle you're on. They can do that with monetary policy. Blocker didn't really listen too well, but you can do that. Look at the dollar. They're trying to break parity already. I think we'd be remiss in not stating that. Has this had its run? Because if this has had its run, then maybe we need to look at the industrials and say maybe they've had their run. And I know Kevin that owns BA that asks me every day in the pre-market live what I think of BA. I've been telling them to stay away from it for God knows how long. But they went to that Dubai Air Show in here and they crushed it. Absolutely crushed it. 47 more planes they sold. It's insane. So that tells you where the economy is. I mean, look, if you're in the economy and you're looking at the economy and they're going out there and somebody, whoever it is buying more, Dreamliners, 787s, and you're buying 40, you sold 47 more of those than you think. Do you think that they think the economy is going to expand? And I'm going to go off on a tangent. And then we're wondering why names like Expedia or Bookings are breaking out, right? And then we'll all realize 6 months later why that's happening, right? So I think that there's something to this, and I did go off on a tangent there on purpose. I would start paying attention to what's happening technically and then start diving into the market and see if we can understand why by going through, yes, I'm going to say it again, the stool, or just understand the macro, right? Figure out the macro, part of that equation and why it's happening, because it's not normal. It's just not normal. Now, there's a bunch of names I want to go through, but before we even get to those names, I really want to get into this NAAIM data because I see it being misinterpreted, and I really want to show you the smart money, dumb money, and how to calculate that. Now, one economic data point that people look at is the NAAIM number, and really, we're going to get into specifically what this is. And what they say was when we get over a certain number, you want to pay attention. I do agree with this before we even get into it, but you might want to pay attention for a different reason than people think you're supposed to pay attention to it. So if we look at these key areas, you can see when we're spiking and then we're over 100, how rare is that? Pretty rare. And we're going to dive into the data here in a moment. It's important for us to understand what this is before we go any forward. What I see a lot of people doing is saying, oh, if we're up here, well, then that's really bad. I have a different interpretation of it, and let's understand what it is, and then we'll go forward. So to start with, if you just type this in, NAAIM.org, you can go and pull this up yourself. Go take a look at it. And what it's going to tell you is it's going to explain the average exposure in the U.S. markets reported by members. So members of this association, they're going to report where they're at. And we'll show you the breakdown in a moment. This is not predictive in nature. I'm going to say that it's a little predictive in nature to some extent, but not in the way that people are utilizing it. The primary goal of most active managers is to manage risk reward, the stock market, and stay tuned for what the exposure is doing at a time. As the name indicates, this is just showing exposure, which provides insight and actual adjustments of risk managers. This is what their brokers are doing, right, to their clients. Think of it that way. All right. So you can see right here, this was the peak, July 26, 2023. And you can see what happened here in the market at that exposure. And then we came down. So this is July 26, 2023. And you can see the exposure and that we came down. We're going to talk about this. And now you're here. And people say, well, last time we were here, this happened. This is all going to tie into the stool a little bit as well, but you need to understand the distinction. So then what they do is say, okay, well, here's the S&P, and the S&P is somewhat following that. Isn't it? Yes and no. So if we just go here and just pick any data point and you go, okay, well, here's the low October 12th on the S&P. And then you go here and then you go, okay, well, here was the low of the Purchasing Managers Index, right, on the 28th. And then you can go here on the 12th and you can see this little maneuver here and see the difference. And you can see here the 12th and you can see the 28th. Hopefully you can see that difference, 28th, 12th. So actually they were shorter than the market, right? They were shorter than where the market was. Market comes in and then they actually start buying. Some people could call that an actual positive divergence in that number. And maybe that's something that we should pay attention to. But there's an important factor that happened on this date. And I think that this is something else that we should just spend a moment understanding what happened on October 12th and why the market did what it did in 2022. There's a methodology to this. Just stay with me. And so let's get into where they're talking about. This week's number was 102.71. Okay. This was the quarter average. Okay. No one really cares about the quarter average. These are the numbers right now. And you can see how they are increasing and where you were October 25th. And you can see how they're increasing and where we are right now. Note the jump from November 1st to November 8th. Now, you can get a copy of this if you want it. And what this is all the data, right? This is all the data coming across mean, most bearish, first quart, second quarter, third quart, who's the most bullish, standard deviations, and you can go from there and just walk through the data. And you can actually go all the way down quarter by quarter, week by week, year by year, and just go through it all. And this data set goes to July 5th, 2006. So if you take this data set and you were to sort it by the mean, which is also going to be the exact NAAIM number that is then going to be plotted on that graph, and you sort this data, you get December 17th, 2021, you get all these dates where the highest averages are. And you can see that it was around the 17th, the 21st, 2021. Now we know why that was happening there, the injection of capital. And you can see the 20th, and you can go back to the 17th as well, 2020. Now this is going back to 2006. And just keep in mind and look at all these dates on when we were this high up. And this is the last 20, but if you keep going, you'll see even more dates, right? You come back to the 13th, 2013, and you can go all the way to 30. And these are all the times that you're really over 100. So out of all these recordings since 2000, and if you go back to 2006, all these recordings, the majority of these were 2020, 2021, 2017. Now, if we take these data points and we plot them on an S&P weekly graph, this is where two of those top 30 actually were, and these were over 100. So now if you mark from here and you mark all the way up to here before the great financial crisis, is this telling you the great financial crisis is coming because of this? No, far from it. And there's more movements all the way over here as well where you can plot, but I'm just going to take the ones that are in the top 30 for now, just to make it simple. Because when you have 30 data points, you actually have statistical significance. That's why I'm taking 30. So if you're taking a look here, all right, so there's your move. If we were just to take this and just go, all right, well, this is when that number popped up, and where were we just a year later? And you come across to take you to January 8th, right in here, and that's going to take you to roughly about 8 or 9% on the market. Let's say 8.5% on the market. And you come to 13 and you go, okay, well, here's where that number kicked in again, all by itself right here, which is kind of interesting. You only had one data point here. And then you say, okay, well, where were we by 14? And we just come out a year later and just go 14. And you would say, okay, well, we were 23% higher from there a year. All right. So then you come into 18 or 17, and you had a whole bunch of them in here. Take the first one, all right? And you take the first one and you go out a year later and you just go to September and you come up. And where were you? A year later, you're up 15%. All right. So you can see this, even if you took the last one and came over, you can see that you're still going to be up, right? Okay. If you come into here and we start getting into these numbers, there's a couple key things to take a look at. Number one, when we're diving into this time, when we're diving right into this time, we are all aware of how the Fed just absolutely hosed everybody and just injected tons and tons of capital into the market, which just created a huge bias. So the question really becomes, were brokers or money managers, whatever, however they want to refer to themselves this week, if they were here and if they were heavily invested, is what they did wrong because of the capital injection? And the answer is no. They knew that because the Fed was adding liquidity that people needed to be long equities. Right? If you had a basic understanding of macroeconomics, you knew you wanted to be long equities because of what was going to happen to the market. You just knew it. So you can kind of go through these numbers and you can see without me even doing the math on where you're at. And then you can see here in November 1st, how once again we peaked. And then people will mark this peak and they will say, oh, well, this clearly shows the causation. When they peaked here, that's why we went down, because everybody got excited. So here's what you don't want to do. You don't want to assume something is the cause and therefore it is correlated to the movement. You don't want to assume that something is the cause and that then correlates to what happens next. I'm going to explain why. The people that were investing right here did not know that Powell was going to change his stance here. They didn't know that, right? When Powell changed monetary policy here and said, we're going to stop doing what we're doing and injecting billions, actually over $1 trillion of capital into the market, This changed the landscape. So can you be biased and actually take these out? No, because they're playing the hand that they're dealt. So the money managers or brokers, again, whatever they're referring to themselves this week, this is what they're doing. And so that you can't really play, you're playing the hand that you're dealt. And you understand the hand because you understand macro, right? So that changes right here. And they change with it. So as they're changing, this is declining. I'm not going to bore everybody by going through those numbers. But there's a couple key things that we talked about earlier. Remember when we talked about that 22 data and said, why here did we have that change? Well, you had a change because you had a macroeconomic event right here. Let's drop that there for a second. And I'm trying to point this out for two reasons. So right here, you had a macro event. What was that macro event? The CPI came out and it peaked. So CPI came out and peaked here. Now, did the people here that were betting that the market was going to go down, right? Did those people, the money managers, did they know that inflation was going to peak here? And the answer is no, they didn't have a clue. Nobody did until you actually went through those in an itemized line by line list, which you really needed an investment bank for because most people are not going to spend all day diving into those numbers to see if we peaked. They're just going to print the headline number. All right, so then you can see why here they may have been caught off guard. And then we could say, oh, well, that means when this shifts, we should pay attention to it. I'm going to tell you how I would use this data, and I think that it's a better way to utilize the data. But if you take a look here, July 26th, this is when we peaked again, just like here. Again, it's telling us that clearly we peaked, therefore we should be getting out of the market. So if we went by that thought process and we said that this drop is correlated to this and this drop is correlated to that, then what happened here? Doesn't make any sense, right? Well, I can say that we had 1.7 trillion injected in the market and therefore that's why this was negated. Or I could say that it was monetary policy and the macroeconomics here that caused these people, the money managers, to inject equities for their clients into the market and to go long. The same process and macroeconomic data that they had here, the same process they had here. What happened here a week later? Japan came out and changed their monetary policy and started saying we're going to allow bonds to go higher. So monetary policy changed here. This didn't reverse because NAAIM hit a new number. Monetary policy changed here. You remember this. We did a whole piece on this on Japan and how they changed. If you're new, you're not going to remember this, but we did a whole piece on this. Right? We went over it for months. We were all about economic policy. We were all Japan experts for about a week. So we remember when this peaked, and that's why this reversed, not because of this number. Remember, just because something happens does not mean that it's correlated to the movement. And that's a really important distinction. I'm not telling you to not look at it. I'm just telling you to pay attention to it. All right. So here we had what? Why did we spike? Change in monetary policy. Powell said he's going to stop raising rates. What happened here? Powell admitted that they overshot in his own weird way. He admitted it and said they're going to have to start cutting at least 75 basis points, if you really read that language. Here you are again at 102. What are people saying? Oh, well, we're here, so clearly we're going to drop. Now, I'm not saying to not pay attention to this. What I'm saying is understand what is actually moving this. And the way to utilize this would be, is it going up or is it going down? And there's another way to look at that as well that I think, and I'll go over that in a second. But really what you want to look for is, are they investing capital in the market or are they decreasing their investment in the market? I would look at that more than just saying, well, these peaks are clearly showing that when you get to that number, we're going down. Sure. As long as Powell comes here and stops injecting massive amounts of liquidity into the market, okay, as long as Japan changes their monetary policy here, right, and as long as Powell says we're going to stop cutting rates or stop raising rates and we're going to start cutting rates, sure, then this marks. Other than that, this in a bowl of soup gets you a bowl of soup. Now, I'll always get asked these questions in the comments, and I love the comments, so please keep them coming. Why are you showing me this if it has no correlation? Well, I'm not saying that it's not correlated. What you want to do is you want to see, is it going down or is it going up? That's what you're more interested in. Are they increasing their exposure to the market or are they decreasing their exposure? Okay, that number theoretically can get to about 200 with the way that they calculate it. But 100 is a high number. And I'm not saying to not pay attention to it. What we're looking for are signs of, are you decreasing? Are you decreasing or are you increasing? That's how you want to look at that number, not be that set in stone where you're going to look at that number and say, oh, well, this is why. No, if it's change in monetary policy that is affecting why they're doing what they're doing. Now, as everybody's aware, this smart money, dumb money, we don't refer to this as smart money. We don't refer to this as dumb money. We refer to this as institutions and we refer to this as retail because that's how this is calculated. If you look into the calculation, and we've gone through this several times before, I'm not going to bore everybody with it. It calculates not the confidence in the way that you would just think about, hey, how are you feeling about yourself today? But actually looking at investment vehicles that institutions use and retail use, right? Okay, so that's how they're calculating that. So that's how we want to look at this. So what we want to look at always is when we are below this level right here on smart money, which is in blue, or institutional money, and we start popping over, you're usually peaking. So in this case, you're popping over, and what are you doing? You're going higher, starting to roll a little bit, but not really. So anytime that you see that, you want to just pay attention to it. When this starts to increase, institutions are buying as things are, quote, getting cheaper, right? All right. So what does retail do? Retail tends to peak when the market peaks, but does that mean that you should be getting out then? No, because it could pull back and then go higher. Well, what's the main difference? The main difference is when you start to decline and you get below your 0.7 line. So we're not there yet, but there's a couple things here that we should talk about. First and foremost, if we just come straight across, you'll see that this is pretty much the highest level in 12 months, and we're going into a new year. There's a couple reasons, for tax reasons, that should be somewhat concerning. It is for me, and we're going to address that next. But there's a couple things here that is a little concerning, because retail's up here. Retail's fully invested, way more than fully invested. We know that, right? And retail's more worried about the tax ramifications than institutions. Why? Institutions pass them on to retail. It's just really that simple if you think about it, right? So if you take a look here, you've crossed here and you're trending up. So when we think about this breaking here, did that really happen? Not really, right? So when you start thinking about it here and you're going here, right? You see that break above, or you see that break here and then here, right? You can see the difference. Okay, so what happened here? All right, well, you kind of had a change in monetary policy in December, mid-December, didn't you? Said he was going to cut rates. All right, so once again, monetary policy does what? Change the way that we're looking at our technical indicators. Something to think about. So are there times when this is a great technical indicator that is going to be highly correlated? Yes. Are there times when these indices and oscillators that we're looking at might be less correlated? Yes. And then you're going to get a mean on those, and people are going to say, well, this is the mean. Instead of saying, well, this is the mean, this is the way it works, you're fighting for inches. So when you understand that you're fighting for inches, this is by Sentiment Trader, by the way, what we're trying to do is go, well, what are we fighting for, right? What are we really, we're fighting for inches. That we're always looking at the same, anyone can get this for $60 a month, right? What we're trying to do is figure out how to utilize it better than everybody else. If you don't realize you're in a competition, you are. Here's Sentiment Trader. They have a lot of great tools. I have no affiliation with them, but what I want to point out again is back here, look in February. Well, that's pretty highly correlated. Well, that's pretty highly correlated. This doesn't really get much more highly correlated, right? Okay, what started to happen in July? Oh, you had a change in monetary policy. All right, okay. So I'm not saying to not pay attention to this, but just understand where it is. What's starting to be more troubling about that is this. As these get closer together, that becomes something that is a concern. Institutions are only going to eat so much of retail. And the higher that we are here, the further we have to drop. My concern is this lower low right here. That's my concern. I look for little anomalies like that. So we actually dropped lower here, meaning they're getting out faster than the market's going. We went sideways, obviously, into the end of the year, but this is somewhat concerning because we are going into tax selling. So while we're looking at that NAAIM data, and we completely understand that much better than, hopefully you understand it much better and how to utilize it than we have in the past, we have to look at smart money, dumb money, because this is going to indicate to me a lot faster on what's going on out there. And then you're going to see this you'll actually see this reflected in those NAAIM numbers. Why? Because we don't refer to this as smart money, dumb money. This is retail. Retail, besides them acting on themselves, and I'm retail as well, besides us acting on ourselves, you might have a broker, and he might be acting on your behalf. So what we're seeing is these get closer together, which that correlation is something to worry about. But to bring this all home, we want to watch this closely. We're certainly going to watch it next week. And we really want to focus on how they're going to position next week on the tax selling. And that's something we're going to get into right now. All right. So I hope that gives you some clarity on how I'm viewing this. I think it's something that we need to pay attention to. I do think that we want to watch the retail side of the trade. And I do think it's a concern. Now, my biggest miss on the year, and I'm showing this for a reason, my biggest miss on the year was I thought retail was going to get smoked. I thought retail names were going to get absolutely hammered. And that is not what happened at all. A matter of fact, this is when I thought it was going to happen, and we all know what happened in here, and I won't rehash it again. Well, I might as well. Fed said they're going to stop raising rates, so the consumer all of a sudden got stronger. I'm not really buying that. There's a couple things I'm not really buying. Number one, I'm not really buying that the consumer miraculously got stronger just because you stop raising rates, because we all know where credit cards are. Second thing I'm not buying a VIX at 12. I'm having a real tough time with this. So to me, the VIX determines where we are in the pecking order. In other words, how much risk is in this market for the equity markets? That's how I view it, because it's puts on the S&P, right? Are we really back to pre-pandemic levels of risk? Are we really? With everything that's going on in the world, with you have two wars going on out there, you have rates substantially higher than they've been for decades. Are we really at that level? I'm not really buying that. Now, it doesn't matter what I'm buying, okay? Because this is what they're selling. And what matters is where it is. But these are two things that I'm really very concerned about that I just don't understand. I don't understand how they're thinking the consumer's that strong and how people are thinking there's that little risk in the market. So these are two things on my radar that I think are worth paying attention to. Now, I think it does take a moment to go through some of the larger moves of the year and say, okay, where is this going to put us? So I refer to these as the Magnificent Seven, as everyone else does. And you have XLC here, and you can see the retest and then the break and then the push through. I have a hard time believing that people that bought Meta and have an average cost across the board from 125, where this is, to 350, are not going to take some kind of profit in January. I have a real tough time with that one. And I think you're starting to see signs of that. And so what I would suggest you want to do going into next week is look at stocks that are up the most and expect to see some kind of pullback. And this usually happens over the first 3 to 5 days. It is the exact opposite of what happened going into 2023, January, where you saw these names rally. You'll remember this was November, December, and you'd see the selling, and then you just see the rally as soon as January hit because of all the tax selling that went on. I think you're going to see the exact opposite of this in tech. And I think that you're going to see these kinds of names actually come in a little bit. And I think you're starting to see signs of that. So I would be looking at the ones that were up the most and seeing if they're going to come down. Now, that does not mean that they're going to come down all year. I'm just saying that for next week, Tuesday, Wednesday, Thursday, Friday, this would not be surprising to me at all to see that dumb money indicator break below that level. And this might be the impetus that does it. You start looking at names like NVDA, and you're having trouble in here. You are having trouble with 500. There are massive sellers at 500. So one of the tools that I use is showing massive selling at 500. So when it gets through 500, if you take one thing from this video and you're looking for something actionable, you start closing over 500. Like you really start closing over it, not just like once, but you start seeing that. This is setting up for a massive move. And I still believe that. And I made a statement about 6 months ago that I think that this is bigger than Apple. And I truly believe that. I think this is going to be the biggest company in the world. I have my beliefs for that, but I'm trying to get through next week. See what I'm saying? There's like cycles within cycles. So I have to get through next week. And right now I've got a control bar. Everyone knows that that's how I refer to these, right? As control bars. And you can see how it acted here, right? This changed the tune. This changed the tune, right? This changed the tune. And so you can see that right here. So we had a really great short in this off the open on Friday, and we did exceptionally well with it. Since I brought it up, you can just see the timestamp right here. 1040, we bought the 495s. I paid 630 for them. My goal was to hold them into next week. I just rebought other puts later. Let me pull this down. But I rebought other puts later in the day. But why am I showing this? Because this is kind of where my head is. We were actually able to short AMD as well, and we did all right with it. But overall, I did not expect to really see not just follow through, but I didn't expect the bounce the way that it did. But we still did. We did massively with the chart. I mean, if you go and take a look at when we put this thing on, I mean, we just nailed the trade. I mean, it wasn't really that hard to see what was happening here, right? If you look at this, but and then the pullback, and this is what makes those days so great. So this is definitely, I love days like Friday. I mean, they're so much fun to trade because people think that you're going to get follow through, and you rarely do in either direction. But, just positioning. But you're going into next week. So if we see over that 500, that's going to tell me that I'm wrong. If I start closing over that 500 next week, but you start thinking about it, like what is the impetus for people to put money to work immediately in these names? Is it going to be the inflows from 401ks that's going to do that? That's going to get that money in there? It's not going to happen till Friday anyway, right? Because of the paychecks and the way that it works, or the week after, if your paychecks for 2 weeks. So you start thinking of those inflows from 401ks into the big names. Sure, that can happen, but I think you're going to see the tax selling, and I think that's going to be a weight on there for some time, personally. But I would be looking at the big dogs and saying, these things are probably due to come down a little bit. And that's certainly something that I would pay attention to. I do want to do one quick way to look at relative strength and go back to one point. But before I do that, I want to just stay along here. So I would be looking at the Apples of the world, the Microsofts of the world, things that are up dramatically like this. Apple's running into some real issues here with products and kind of their tactics. Everyone always thought of them as like just the real nice guys that keep changing adapters. But you start seeing what's going on with the Apple Watch. So, they're having some issues there. There's some technical stuff going on here that I wouldn't be too thrilled about if I was a shareholder. I'd start having some real concerns here on what he's doing. But for us, what are the other sectors that we should really be paying attention to? How do we position ourselves going forward? What are those sectors that we need to be paying attention to? I think that's a fair assessment. So for me, if I take a look at XLRE, that's the one that I was really very interested in for tax reasons going into when we were in November and we started buying these names right in here. We started buying SLG. I'm a big buyer of just New York office space. I just am. I think it's absolutely ridiculous to think that this is going to miraculously go away and we're all going to be living in the metaverse and you're going to go to work as a giraffe. I think it's just silly. But you can see from that break we broke down. So why are we doing this? I think it's tax selling is where my head is with it. So it is what it is. I'm in these for the long term. These stocks, this is basically trading a little bit over book value. SLG's under book value. You can do what you want with these names. I like them longer term and I'm willing to ride the waves for them. When I say longer term, I'm looking out a year, just FYI. But I would really focus on the REITs and start going through those. There's names out there that are still trading way under book value. BDN, I believe, is still under book. Book value on BDN is 876 is what they're saying. I don't really want to play the secondary markets. That's not what I'm trying to do. BDN has a lot in Philly. I'm very familiar with Philadelphia, and they have a lot in Texas too, but they started gravitating towards Texas, but it's secondary space. It's not your primary driver. So I have my belief in how I'm playing it, but I would not sleep on these names. Another one that I have not gone near, and I could be way off on this, like way off. I've been thinking a lot about this. HPP, which really focuses on San Fran, and there's a couple guys in the room that are building these. That's why I love the community so much, right? There's difference of opinions. I don't need to be right. I just need to present the information, then people do what they want with it. But there's guys in the room that are buying this and absolutely crushing it. Now, this thing's got a $23 book still. Well, let's just say that, and they're based in San Fran and LA, which is just an absolute dumpster fire for businesses right now in office space. But let's just say that they're worth 50 cents on the dollar. I mean, do we really think, despite all the hyperbole, do we really think that nobody's ever going to have a office in California? Like, people are going to figure it out, guys. New politicians will come in, new ideas. People, we know the game. We've all been around long enough to see how this game is played. If you think about that and go, okay, well, I could get back to 14 and still be under $9 under. If I can get to 14, I'm still $9 under book value. When you start thinking about those kinds of plays, there might be something to that. What I might even be going through with like VNO is the fact that I'm overbooked now, and people are saying, well, do I really want to pay overbook when there's so many great deals out there, right? And that's why I like doing these on the fly, because it also helps me think and you can understand where my thought process is. Like, geez, maybe I'm wrong. Maybe I should be going back to where did I buy these? The other sector that I would just tell you that I can't figure out how it's going to go down, and what was so fascinating were the comments on this one. When I put this out there in the previous video, so I want to bring it up again. I don't know where supply is coming from on the houses. I don't. You have people that are locked in gratefully in their mortgages that are getting 3.5%, 3%. I don't know where they're going. I don't know that they're going to get rid of those mortgages. That said, I don't like paying this amount of book value for these kinds of properties. I buy home builders at book value. But when you start looking at how these stocks are acting, it is very hard to not want to be involved in them. NVR has always been a beast. GBRK, what is it? GRBK, that's the one that Einhorn's in, right? And been playing around. He buys it in the 40s and then blows it out when he gets in the 50s. So like, you start looking at these names and going, do I really want to be in that space? I don't know where my edge is there. I'll tell you where I think the edge could be. I think the edge could be still in the Home Depots of the world and the Lowe's of the world. I wouldn't sleep on those. I mean, they've had monster moves and we've done very well bat and nail around I'm not so sure that moves over, but are these names due for a rest? Yeah, I do. I think that the home builders could come in pretty hard here going into January. And that's another sector like the Magnificent Seven that, you might want to just take a slow roll there and take a look at like DRN or DRV, I believe is the bear one, and go, do I want to look at this? And here's my problem with me pointing these out. I'm going to point out a couple of these. So like there is nothing technical about that says it's going to go up. Like there is, like that is disgusting to look at, right? So when you start looking at like DRV and saying, well, that could rally, or I say the Magnificent Seven is going to have a problem, and I start looking at like these 3X ETFs, like, I mean, these things are so disgusting that it's really hard. Even on Friday when I was telling people in the room, like, hey, this is how I would play it. I mean, it is really hard to look at these charts and go, I need to get involved. Even if I do something as simplistic as like dropped a mark on them that gave like a buy indicator here, right here, like a conservative buy indicator on these. And I'm sure that you're going to see stuff like that on DRV too. Let's see if we got one. No, but you're getting there. You're getting that 13 pretty soon, right? You already had a 13 here, but you're getting that 13 reading right there. So like I do use the mark in that sense. I use it for an overlay to get a sense of just, I always say the words exhausting, but when you look at stuff and it's like, oh my God, this is so exhausted, like the selling. So yeah, you could look at it. They're not really my kinds of trades, but I get that. And I understand that they might be bear funds that you might want to watch next week. DRV, you really might want to watch this FNGD. I have more fun taking FNGU and just shorting it. To me, it's just, it's easier. And it'll have such a, to me, the move will be the same, but I guess I feel better because I have this liquidity associated with it. And I can understand the technicals a little bit better. But to me, that's, as I like to say, people make fun of me, but you see like the sell signal up here, like this is absolutely glaring that you've come a long way in a short period of time, and go from there. So keep that in mind. But that's where my head is on the sell side. Now, on the buy side, and I think if the whole market comes down, everything's going to come down with it. This is where my head is. I'm leaning short going into next week. That's where my head is. But there's certain sectors I still want to go over and show. So if we take a look at TAN, okay, solar was one of the worst performing sectors out there. You had massive tax selling. This pattern, if you take a look at TAN right here, and you see how you're down in November and then lifted in December and then went from here, let me show you something. Here's XLC, November, December, and then starts lifting, pulls back, and then rallies. Okay, you're setting up the same exact way. TAN's setting up the same exact way. I would not sleep on solar going into next year. I'd be paying attention to solar. I really would. The other thing that I'd be paying attention to all year long, and this is probably one of the better trades that we've had in the room recently, but I'm laughing at this move because it really wasn't really like that if you take a look at the 5 minute, but they kind of did this at the end of the day, but whatever. But you got to new highs 87 today, and I really just wanted to watch how this was going to play out at the close. You never know how it's going to go. I have a position in this. I have a very large position in this. I've done exceptionally well with it. I married puts to it, and then I sold calls behind it. I got a lot of comments on doing those kinds of videos, explaining this stuff. I'll tell you now, my thought on that is I'm just going to do some kind of like live stream, and we're going to talk about live examples somehow on a live stream, because it's pretty in depth on how to do this and what I've done here. Because I mean, I'm long stock, I bought puts, I sold calls against that stock, and I have other long calls. And so if it goes extreme either way, I'll do very well. But that's just how I'm positioned for it. But I'm surprised this is still in the same entity. And if you go out there, the sectors like IMGM, like all these buyouts that are out there, I'm not going to go through them all, guys. You know that they're out there. There are so many buyouts in biotech. And I really think that is another theme that will continue. And I think that you're going to continue to see consolidation and buyouts this year. Another one that we're playing and doing really well with was this ANSS. And these kinds of names and these kinds of buyouts is a theme that is going to continue. So I do really appreciate that. It's been I really appreciate the comments that are below, and it's really been an honor doing this with the YouTube. I really have had a great time putting these videos out there and getting the feedback and you guys sharing it. So please continue to do that. When I start getting asked about the other names, like, well, what do we do with Tesla? And for me, cleaning this up, I thought, oh, it's finally going to go. And guess what my answer was? It's not actually going to go, and it actually broke down again, and it keeps rejecting this DTL. What's crazy about this DTL, and I just want to walk through it, is you're just sitting up here this whole time, and it just keeps going from there. So my thought is to watch this very, very closely, not play with it. But we have to understand that, yes, you've completely broken out on the stocks. Yes, you're hitting new highs. But there is going to be a certain group of people, specifically the retail investor, that is going to want to lock in their capital gains and just do it this year and go from there. So we can see a pullback on this, and we just looked at where we are on the NAAIM, right, indicators, and we looked at how that correlated to dumb money. So we know going into this week who's actually in control of the market. That's it.